well, thank you. So just to touch on a few points that Alex went over. First, on the way home last night when I was driving home on WLS, they had someone on from, I forget what foundation or association here in Illinois. How many people think in Illinois you don't pay enough in taxes? So their proposal, I haven't read it. I was trying to write down the website as he came in. I don't have it in front of me. Basically, what they want to do is raise everybody's tax from the 4.95 to 6%, and then they also want to tax pensions in Illinois. That's their plan to save the state. Nowhere in that conversation was there anything about the state cutting back or spending less money or being more efficient or that for it. It's all about just having to spend more, right? So everybody in here, you all said you don't think you spend enough in taxes. So if they should go through with that, you would see that potentially happen for it. I'm not surprised that that's what's out there. I actually think it's kind of low as far as what they want to do for it. I do think if they ever start to tax pensions in Illinois, then you'll see everybody who's retired leave. All right. So one main reason you stay in Illinois if you're a retiree is because your retirement assets and income in Illinois are not taxed at this point in time. I always qualify that at this point in time. Okay.
The legislature, they're proposing that?
It was done by an outside agency that was proposing it, but they are proposing it to the legislature to take up for a vote. Yes. No, the Constitution, so the question was with regard to the Constitution on taxes. The Constitution on taxes says that you can't have a progressive tax. That's why Pritzker, when he said that he's going to raise taxes, have a progressive tax, never going to happen. Because that has to go through a constitutional amendment to change the constitutional law in Illinois that says how taxes are paid. So basically right now Illinois basically says a flat tax, all right? Whatever tax it is they want to put on there, but it's a flat tax. Right now it's 4.95%. If you want to change it to a progressive, you have to change the state constitution. That's never going to pass. And if it were to pass, that's not going to happen for 4, 5, 6 years down the road, right? Because it has to go through, it has to get on the ballot, it has to get amended, there's a time period for it. So in reality it's never going to happen with regard to it. So it's not that they can raise taxes, they can raise or lower taxes anytime they want, but they can't have a tiered level, they can't have a tiered system essentially for it. So I was listening to the news the other day, and Alex is from New York, so we were talking a little bit about this. Governor Cuomo was crying because a lot of people are leaving New York and they're all heading to Florida. Why would they be heading to Florida? It's cheaper, right? Florida has 0 personal income taxes. I don't know what the taxes are in New York, but I understand they're almost as bad as Illinois in that for it, right? So why is he crying? He said, well, it's the Tax Act that's causing people to leave. Nowhere did he look internally and say, well, maybe we charge our citizens of New York too much money, right? Maybe our tax rates are too high. Maybe we need to get more competitive. It's almost like having a bad company, right? If you have a poorly run company and they're going out of business, they're blaming everybody else that they're poorly run, right? So we're a poorly run company, but we're going to blame the competition because we're going out of business because they do it better than we do, right? So he was crying about that. I'm sure, and it was interesting because I was reading an article yesterday that was talking about kind of this progression, and there were 3 states that were mentioned with regard to having population leaving for Florida. One of them was obviously New York. The other one was New Jersey. And can you guess who the third one was that was mentioned in the article? Illinois, right? So between 2010 and 2017, between Chicago, Naperville, Elgin, Rockford, and Peoria, Illinois has lost population net of about 325,000 people, right? They have left the state, never going to come back. Okay, my kids are one of them, all right? Hopefully. So if they've left the state, what would some of those 325,000 people have done? They probably would have bought stuff here, right? Which meant they would have paid sales tax, right? Some of them may have worked and they would have paid income tax, right? Some may have bought gas, so they may have paid gas tax in that for it. When you lose that population, guess what? You lose the tax revenue potentially that goes along with it. So if you're a corporation and you're losing sales, what do you have to do? You have to potentially cut, right? Reduce staff, cut back production, reduce costs somehow for it, right? The state has done nothing of that nature with which to address it. And what happens when you lose population at the federal level with regard to funding. Funding for the states is based on population. So if you want roads and bridges to get fixed and your population is continuing to decline, what's going to happen to the money you're receiving from the federal government? It's going to go down, right? Because they're going to say, well, Illinois, you have 325,000 less people, but Indiana, you have 325,000 more, so guess what? You need more to build up your infrastructure, keep your roads running. The other people don't. When you lose that funding, what happens to the state? The state then needs to somehow keep those roads and bridges and everything functioning, right? So what do? They raise taxes, right? They don't cut back. They don't try and fix the problem. They just continue to exacerbate it. So taxes are going to be a big issue in there for it. Many of you may have received your Cook County property tax bill, right? Is that good time of year in there for it, right? I didn't hear anybody yelling and saying that they were happy about getting their tax bill. I did not hear it. So in the tax bill portion of it, I don't know if you, I was fortunate enough to get a copy of the tax bill looking at the section. So how many of you looked at the middle section of the tax bill? The middle section, right? So the middle section, especially if you're in Chicago, tells you the funding levels of the municipality pensions that are there, right? Doesn't tell you how they're funded or anything anymore. It used to tell you that, but doesn't tell you that anymore. It tells you the deficit, right? So if you remember a few months ago, Rahm said that he wanted to borrow $10 billion to shore up pensions. Well, if you look at that section of the pension, if you look at that page there for it, last year in 2017's budget, it was $68 billion underfunded. Well, they borrowed $10 billion, now it's only $60 billion underfunded. But now you have the bill that's due on the note and everything else for it, right? So at $60 billion, it's not funded, right? So that means it's still going to run out of money potentially at some point in time. It's just a matter of when, right? So you have to continue to look at these costs. You talked about CDs. CDs, the old term on those is they're certificates of depreciation because they depreciate. And if you think of it, when you think of your money, you need to think in terms of two ways, either cash or cash flow or income form, right? Just like a corporation would. Everybody needs to have a level of cash that's available for emergency purposes. If you're planning on buying a new car or buying a house or something, you need to have cash available to do that for. But is your money really meant for cash, or is it meant to generate more income for you, right? If it's meant to generate more income in that for you, then is the value of that what's important? Or is it the income that's important? So for example, if you have an apartment building, and let's say you're getting $1,000 a month from the apartment building, that apartment building's value could change every day, right? You could get it evaluated, get it, adjusted on Monday, and it could be $100,000. You could do it on Tuesday, and it could be 105. You could do it Wednesday, and it's 100,000. The value is not necessarily what's important or why you bought the apartment building, right? Why did you buy the apartment building? You bought it for the income. You bought it for the cash flow, right? What's important about it? Is it important that the value of the property stays exactly the same? Maybe if you're paying property taxes, it is. But what's more important about it is the income that you're going to receive from that property, right? So when you think of terms of your cash, of the money that you have made sitting on the sidelines of that for it, is it meant for cash to purchase a large purchase or something of that nature, or is it meant for income, generating cash flow off of it, right? Is the income off of that going to pay for your vacation, right? So if you have money set aside, is the income off of that going to pay for your property taxes, right? If property taxes continue to go up, many of you may be on pensions or on Social Security, but if your taxes rise and those assets stay pretty much the same from the income standpoint, what overall happens to your standard of living? It goes down, right? Because now you have less money available to spend on something else, right? So you have to cut costs somewhere else to be able to now afford because what the rise in the price over here was, right? So that's where you need your assets and your monies to generate income, right? Income becomes the most important part of it, not necessarily the value of what the cash is, right? So that's why it's a difference between cash and cash flow or cash flow and income, right? And the assets that generate income can be taxed as well, right? So on a, as I mentioned, on a CD, earn interest on it, that is a taxable event in two ways. Not only is it taxable at the federal level, it's also taxable at the state level, right? So if it's roughly a 20% tax at the federal level, in Illinois it's a 5% tax on that, so your 2% is now down to roughly 1.4%, right? Well, on 1.4%, if inflation is running at 2%, what just happened? You didn't keep pace with inflation, right? So when the economy is growing at 2% and inflation is growing at 2%, essentially we're just treading water, right? The economy grows at 4%, the inflation grows at 2%, now we're actually getting ahead, all right? So one option, Alex mentioned, is about municipal bonds, right? Municipal bonds are not taxable at the federal level. They may not be taxable at the state level for it, but instead of paying 20% tax on that number, you're now paying 0 at the federal level, right? And then you would be paying whatever the state tax would be at that point in time, right? So it's a matter of understanding where the income comes from and how we're trying to make those assets work for you right? So it becomes real important when you start to look at the numbers that are there and where that income is going to come from to cover the cash and the expenses you have going forward, right? Social Security received an income increase this year, right? Cost of living. What happened to a big portion of that cost of living increase? Went to Medicare, right? Remember, the big print give it and the small print take it away, right? So in Medicare, it has the hold harmless provision. It can't go any more than what inflation goes on the cost of living portion for it, right? But those costs continue to go up. And if your property taxes went up, anybody's heat bill, get their heat bill yet for, our minus 54 degree weather and that for it, right? Most likely that's going to be more expensive than what it would be in June, right? Right? So that's going to be more expensive. So where do those additional dollars come from? Well, you can take them out of your cash, right? But then what happens to your cash? It goes down. And if it goes down, it doesn't matter what the interest rate is, because it's just a mathematical calculation, right? Would you rather have 5% on $10,000 or 2% on $1 million? Wait, the percentages are different, right? But you didn't take the percentage to the bank, right? The bank didn't say what percentage are you bringing in. They want to know how many dollars you're putting into the bank, right? So would you rather have $20,000 or $500, right? So it's not necessarily the percentage, it's the cash flow that's being generated from that portion for it, right? And taxes become a very important part of that to start to look at, all right? So it's managing not only the assets you have, but doing it in a potentially a more tax efficient manner to make sure that there's cash flow available for it, all right? Because if you don't, you could end up paying more to the government than what you were before. And it's also important when you start to look at your Social Security and that for it, because if you make too much when you're a retiree with regard to that, that could potentially increase your Medicare premiums if you have income as a single filer over $85,000, married couple filing joint $170,000. Now if you make over those numbers, now all of a sudden your Medicare premiums go up significantly. Right? You get penalized for it, right? Because they didn't raise them, you made too much money. That was the whole idea behind it, right? So it's understanding what incomes count for what you're trying to do and trying to manage that portion as well. So it's not just necessarily a black and white issue, there's a lot of gray in the middle trying to make sure you understand exactly what you have and how it's calculated to make sure it's there for, right? So, any questions on that? Okay. So, when you start to look at the economy and where things were going for it, there was a number that came out the other day, I believe it was about 68% of all companies that have reported earnings so far either met or exceeded what their projections were. So if you put that in terms, if you were playing baseball, you'd be hitting 700, and nobody in baseball has ever hit 700. Ted Williams was the last one at 400, right? So that's a pretty good clip, right? That means more than 2/3 of companies that have already reported are reporting that they're either making more money, right, or at least met what they thought they were going to make for it, right? As companies make money, if you have stocks or you have dividend companies, therefore, what do they typically pay? They're paying, so you're benefiting from all that, right? So when there's the attack of people making too much money or with those people who own stocks, you're in that group if you happen to own you have funds, or you have ETFs, or you have annuities, things, you're in that group that has potentially making money off of those assets for it, right? So it's a matter of just understanding what's there. Don't get tied up in the rhetoric that you're hearing, because it's not accurate, right? They're not giving you the whole story. There's always two sides to the coin, and they're only giving you one side of it. So there's an article this morning that I was reading, was about raising, the Illinois is getting closer to raising the minimum wage to $15 for it. Does anybody know what happens when you continually raise minimum wages? Prices could go up. What also happens? Economically, unemployment goes up as well. All right, because what happens is, if I'm a local Ace Hardware, so to speak, I can afford two people, let's say at $15 for the hour, but I can't afford I can only afford one person at the $15 an hour. So guess what? Somebody leaves. What it also does is accelerate investment into technology. So how many of you have been into a Panera or McDonald's, and now they got the kiosks up there where you can go up and just go punch, 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 give me my burger, my whatever, and that for it. You swipe your debit card or your credit card, and what happens? If I have that, what don't I need? But what did I need to build that? I needed somebody educated enough with which to make the board, right, that knew how to run the machinery, that would do the technology to put it in there. They make more, most likely, than the person behind the counter. I need someone competent and educated enough to install the machine, right? And they make typically more money than the person behind the counter. And then I need somebody ultimately to service those, because those tend to break down a lot, right? So, because they get enough use in there for it. And that person typically is a higher earner than the person behind you. So actually, by doing that, you force people and actually create more educated and a more employed and a more profitable workplace in that for it, right? But you do create displacement. And the problem is that you have to train those people to get there, as long as people are willing to be trained and educated for it, right? So when they start to look at it, you have to look at what the economics are behind it. It sounds good in theory, so to speak, but the reality is not. I mean, imagine if it was you that had to buy something, and all of a sudden what you were buying from the person that was going to fix your plumbing or that for it, all of a sudden doubled in cost, right? You may not do the plumbing, or you might not do the remodel or that for it, because you don't have the money, because all of a sudden it just doubled in cost, right? So it sounds good from the people that don't have to pay it, right? And politicians love to put things in place that they don't pay for, right? If they had to live on the same rules that you and I have to pay for, I guarantee you Social Security, Medicare, all these other problems, they would be fixed, because they'd be living under the same rules as what we are for, right? But since they don't have to worry about it. So, any questions? Okay. So just kind of looking at some things here for it. You know, there was discussion about the trade imbalance in that for it, or the trade war, as they're calling it, with China in that for it. Does anybody know what the numbers are with regard to that? No. If I told you it was only a 9% difference between what we did in 2017 versus we did in 2018, would that tell you that things are in the worst shape? So 9%, we did 9% less because of the quote-unquote trade war. So it was roughly $110 billion in 2012. In 2018 through 10/31, it was roughly $102 billion. That's roughly $8 billion difference for it, about 9%. Okay, on $100 billion, 9% is not very much, right? For it, from that standpoint, and that's from over a 6-year period difference, right? Does anybody know how much the U.S. typically imports from China? Roughly 500 billion, right? So who has more skin in the game, us or them? Them, right? So if you hold their feet to the fire, eventually at some point in time they have to come back to it. One of the reasons that China has slowed has not been so much in the U.S., it has to do with Europe. Europe is actually a bigger trading partner with China than what the U.S. is. And because their economy has not rebounded and grown that for it, that's why they've slowed, so China has slowed as well for it, right? So at some point in time in a negotiation, they're making changes. They've actually cut their tariffs I was at with an economist about 3 weeks ago, and he showed a slide that said it was actually in their reports for the Ministry of Finance or whatever the Chinese program is called, that they would actually cut their tariffs by, I think it was about 10% or 15% off of what they were. Right? So, I mean, so they are making changes for it, and it's only because they're being kind of forced to, and they need to make those changes accordingly with it. Greece issued 2.5 billion euros of 5-year sovereign debt on Tuesday, the 19th, or Tuesday, 1/29 of 19, the first debt issued by Greece government in 9 years. So everybody, when Greece kind of imploded in that for it, they've now gone back out to the market to try and collect more money in that for it. There was one question about the 70.5 in there for it. Again, you're turning 70.5. The first distribution needs to be the year following you turn 70.5 by April in that for it. So if your basically birthday is January through June 30th in that for it, you have to take it in the current year. If it's July 1st through December 31st, it can be pushed off to the following year in that for it. Once you reach that 70.5 figure for it. With regard to the required distributions, it is required. That's why it's called required minimum distributions in that for it. If you don't take them, there are potentially tax penalties that could apply. And it's 50% of what the amount is you did not take out of the account. So if you're supposed to take $1,000 out, then the penalty for it is $500, not including interest penalties and tax penalties, late penalties for not filing it on the return. Then they make it take you out in the current tax year, which means that you now have double the income, and basically you end up giving all that money back to the government at that point in time. So it's better to take the distribution than it is not to take the distribution for it. You can still send contributions to your charities directly from on an RMD distribution. So if you want to give your church, bless you, if you want to give your church or your Cancer Society, diabetes, whoever it might be in that for it, you can direct your required distribution to that entity. It does not count as income. You will get a 1099 for it. You need to have your accountant noted on your tax return that the funds went directly to the institution. Obviously, you'll get a letter from the institution that says you contributed $200, $300, $400, $1,000, whatever the number would be in that for it, and then you get the full deduction for it. If you don't do it that way, then you don't necessarily get the full deduction or credit with regard to that contribution in that for it. So if you are charitably inclined, sometimes it can be better to send your money directly from your required distribution directly to the charity than it would be to take the distribution and then send the check in for it, because you don't necessarily get 100% of the credit in that for it. All right. And you can talk with your accountant in more detail to ask them if making a change would potentially affect you from a tax standpoint for it. It might. I don't know. That's why you'd want to talk with them, because they have all your tax information and that in front of them for it. So, just as an aside for it, the same cities, Boston Red Sox, beat the Los Angeles Dodgers 5 games in the 2018 World Series, winning the game on 10/28 of 18. 98 days later, the New England Patriots, they won, right? I was rooting for them, so I like success in that for it. So consistency and success. Then on a lighter note for it, did you know that the Lego brick was patented January 28, 1958? The company has since produced 500 billion elements, accounting to 10 Lego towers from Earth to the moon. I think I have half of them in my basement, so for it. So, any other questions? Well, thank you very much for coming. We'll look forward to seeing you next month.